Welcome to the Financial Goddess channel. I am Margaret Milutinovic, your business and finance expert. On this channel, we talk all things related to financial empowerment. And if you're one of the existing subscribers, a very warm welcome to you. Today, we're continuing our conversation with retiring on your own terms, and the one area we're going to focus on is the SMSF, or otherwise known as self-managed super fund. There is a lot of talk and a lot of encouragement coming from accountants, if you had one, or even financial planners, to focus on putting extra money towards your self-managed super fund. So as part of this series of us discussing ability to retire on your own terms, we're going to review how does the self-managed super fund help you reach those goals. Self-managed super funds is one of those things that at some point in time, once you start getting to probably your mid-30s, your accountant might have a conversation with you about. In Australia, your employer is required to put superannuation in your account, which has now gone from 9.5% to 10.5%, and it is expected to continue to increase up until it reaches 12% of your base salary. That superannuation would normally go to an industry super fund, or if you don't have one, never had one set up, it will go to your employer choice of fund. In addition to your employer putting money into your super fund, you also have an option of doing additional super contributions. The threshold changes every year as to the maximum amount that you can contribute. So once again, have that conversation with your accountant as part of the tax planning strategy if you're here in Australia. So just a small disclaimer, this particular YouTube video is just for my Australian-based viewers. So that amount between your employer compulsory superannuation contributions and the optional extras that you can do every year to perhaps minimize your tax savings, that amount sits originally in a industrial super fund, and that amount they take out the 15% super tax and they take out their management fees, and based on the fund performance that amount goes up or down. And during the pandemic, a lot of super funds lost significant amounts of money. Once the money in that bucket reaches 150,000 or more, your accountant would normally have a conversation with you in relation to setting up a self-managed super fund. The self-managed super fund effectively means that you are taking all of the money from the control of existing super funds, rolling it into a self-managed super fund bank account. You then become a trustee and you become legally responsible for making investment decisions with that money for the benefit of your retirement, and if there is other family members or a spouse in it, for their benefit as well. A lot of people put significant amounts of money into the self-managed super fund as part of their plan to retire early. When that money is sitting in your bank account, in the self-managed super fund bank account, that is a complete separate legal entity from your businesses and from your individual bank accounts. And you cannot, even though you physically might be able to see that when you log in onto online banking and you physically can move money around, legally you're not allowed to do that. There is very strict rules with what you can use the money for, and those accounts get audited by an independent auditor every single year. So it's important to know that if you do have a self-managed super fund or you're thinking about one, that you need to be able to exercise self-restraint and be able to demonstrate to the ATO that you as a trustee have the capacity to act in the best interest of that self-managed super fund for the future benefit of its members. Not present benefit, but future benefit of those members. Once you have the self-managed super fund, you would have sat down with, again, usually your accountant who sets it up for you, and looked at an investment strategy. And an investment strategy is basically making a decision as to what do you want to achieve out of that super fund. You look at the different asset classes and how much of the total amount of money in the super fund you wish to invest in each asset class. And that would be depending on how close you are to retirement age, the total amount that you have invested, as well as your appetite for risk. Self-managed super fund can be a great stepping stone and part of your plan for retirement. However, it shouldn't be your entire plan. As the saying goes, do not put all of your eggs in one basket. Now, let me explain to you a few downsides of focusing too much on just growing your self-managed super fund without focusing on other aspects of wealth creation and financial freedom. First of all, there is such a thing as a preservation age. So when you have a self-managed super fund, depending on the year that you were born in, so if you were born before 1st of July 1960, your preservation age was 55. It was slowly increasing by each year, and if you were born from 1st of July 1964, which will be majority of you, then your preservation age is 60. That means that until the age of 60, you cannot early retire according to the self-managed super fund rules. So even if you manage to be very successful in those investments, if you're choosing to retire before the age of 60, you will not be able to rely on the income that your self-managed super fund is generating until after your 60th birthday. The second downside of putting all your eggs into the self-managed super fund basket is that it's governed by the government rules. Therefore, those rules can change. And over my 20 years accounting career, so many times where the government changed investment rules for self-managed super funds in terms of what asset classes you can invest and the maximum amount of assets that you can hold in one asset class, and they have backflipped on those rules over and over again, especially as different political parties become in charge. Those rules can flip. So really, putting money in a self-managed super fund does not give you a full control as to when you can draw it and how you can invest that money. Having said that, I still strongly encourage you that if you have at least 150,000 in your total superannuation balance in your account in some industry super fund, I would strongly encourage you to speak to your accountant and look into setting up a self-managed super fund. The reason being is, first of all, you save a fortune on management fees and on bad investment decisions. Over the last 2 years during the pandemic, whilst majority of the industry super funds returns have gone down, my own self-managed super fund portfolio actually has gone up 25% through individual hand-picked investments that I have made for my self-managed super fund. And my management fees for that period was zero. I didn't have to pay some rookie in management company, a straight out of uni kid who has zero interest in looking after my retirement and my financial future. I did it myself. And fair enough, I am a finance expert and I've been doing this for over 20 years, but it's something that majority of you can learn and can master. You can learn about different asset classes. In fact, it's in your best interest to learn about them. Then find the ones that make you feel most comfortable and match your appetite for risk. And then invest in those asset classes yourself. You know, there's no one size fits all. I have clients who just love investing in real estate, and I couldn't convince them enough to touch the stock market or any other asset class. That's what they love. That's their comfort zone. They have taken their time to understand the market in which they're investing. They know when there is a good bargain, a good opportunity coming up. They know when it's a good time to sell. They know what's going to give them a good return on investment. And that is their comfort zone. And they're making a fortune out of investing in real estate. And that's great. That's their knowledge. That's their expertise. I have clients that love investing in cryptos and NFTs, and that's fine. They have much higher appetite for risk, and that's their passion. That's where they invest their money in. Whatever it is, it ends up being your choice. Of course, as with any form of investment, you do need to diversify. But just know this, that no matter how great those investments are, as part of this decision that you're making right now, or consideration of when should you retire, even though you can live off those funds from self-managed super fund on average at 60 versus say 67 here in Australia, so 7 years before you're entitled to old age pension, if you're thinking or planning to retire before the age of 60, you need to have another ways of financially supporting yourself without exchanging time for money. To learn more about those ways, watch my next video here where we talk about how you can retire earlier before you can even touch your self-managed super fund. Thanks for watching, and I'll see you real soon.